Hey everybody, Lawrence here. Don't know why I'm using these, don't need them. Lawrence here from Financial Thing for the weekly Thursday evening podcast, videocast, whatever you want to call it. Let me know if you can hear me okay. I am using a new software setup today as promised. It's pretty cool. I'm still learning my way around it, but hopefully you can hear me okay. Give me a thumbs up if you can. Let me know what the video quality looks like. I'm able to put things on the screen now, walk through some things that I wanted to do with the stream. So we're kind of tacking it up to the what are we in the 21st century, 22nd century, 21st century? Yes, we're doing a tech boost, a tech upgrade. So if things hopefully will go to plan, hit that thumbs up button if you can, everybody. I'd appreciate it. And again, just let me know if I'm coming through loud and clear for you tonight. We're going to talk about everything peer-to-peer investing. Do a little health chat if you want. Many different things. Good. I'm glad that the vision and the sound is good. That's what I'm looking for. Still can't read that CD. Sorry. Yeah, I should block up my head. The CD, yes, it's a very mysterious CD. Welcome to everybody again. Glad everybody is here. We're going to be talking about some interesting things this week. We got some Wellesley news, obviously, some Ratesetter news with them talking about their U-turning on the 5-year product that they've now decided they're going to keep in play for investors. Talking about the provision fund, that they're changing the way that that's going to work a little bit now. Straight water today. What else are we talking about? We're talking about the Seedrs and Crowdcube merger. We haven't really talked much about Seedrs on here. It's not really a peer-to-peer investment, but it's interesting news that they are. Crowdcube is going to be merging with Seedrs. We'll talk about that. We'll talk a little bit about Loanpad. We're going to talk about LendingClub in the USA, and they are going to be stopping their peer-to-peer lending, retail lending too. And a little bit of funding secure news, some FCA action banning crypto derivatives. I'll explain a little bit about that. Some Kuflink news. And that's pretty much it. We'll talk about Wellesley too, and what's going on with them, what my thoughts are. If you haven't been to my website recently, you can go check it out. I have a new Wellesley update on there. I'm going to see if I can make this work. So apparently I can screen share now with the new software, so let's see if this works. Well, look at that. Now you can see me in the corner. This is the new Wellesley update on financialthing.com. So if you want to go check that out, you can just go to the website, financialthing.com. It has it's one of the articles on the very front page. So we have got that. Let's switch back to the webcam. Look at this technology. I'm telling you, I'm really enjoying having this new technology, and what it's going to allow hopefully next week is to have our first guest next Thursday. I can't exactly confirm who it's going to be yet because I haven't had 100% thumbs up, but I think we got the first guest scheduled, which is going to be cool. We'll have a chat about peer-to-peer lending. Hopefully it'll be one of the company heads of maybe one of the peer-to-peer lending companies that you invest through. So excited about that. What else? So let's go ahead and see who's on the stream tonight. Hopefully if we have some new members, welcome to everybody. Glad you're here. We're going to have a good talk. We got first on the comments. Oh, and this is pretty cool. Excuse me for being a little geeky about this, but I'm going to just show you what we can do here with the comments. We can add the comments to the screen. I mean, that's the most exciting thing about this tech upgrade that I get most excited about. so we can see how everybody's doing. Mohammed, welcome. Mohammed Al Nuruddin, I hope I didn't butcher your name. Welcome. I don't think I've seen you before, so welcome to the stream. We have, of course, Brian in Woburn, Norman P, another early bird, Paddy Gillifan, Stephen Hale in Nottingham. We have Alan in Breezy Basingstoke. Paul, as always, in Kenilworth. Alan Toombs is here. Peter Vince from Leatherhead with no rain but wet underfoot. Colin Perry from the Peak District. Chimpo, Naughty, and Darren in Cambridge. Nice to see you. Welcome. And we got Paul Stetson here. And Keith Morris from Lincoln, as always. Vince Beaumont from Coventry. Nice to see you, Vince. Welcome to the stream. And Mike Powell. How are you doing? Mike Powell here from the Lendy Action Group. I'll put the link in there. Paul, yes, I will answer your question about the stocks and bonds relationship. Richard Weber, Southampton. We got John Day in Nottingham, Tony in Somerset, and Rajesh Dodhia. Hopefully I didn't butcher that. Sometimes I do. Hi from Wimbledon. Nice to see you. If you have questions or comments, pop them up on the stream. We'll go ahead and answer them. You have questions about your investments or your peer-to-peer lending investments, I will go ahead and give my opinion. Just a quick disclaimer here that I have to get better at doing this. This information in the stream is not financial advice and has been prepared without taking your objectives, financial situations, or needs into account. You should consider its appropriateness for your circumstances. All investing carries risks. Opinions expressed in this stream are opinions based on my own personal experiences. The FSCS does not cover peer-to-peer lending, and your capital is at risk. Please do not invest more than you can afford to lose. And please remember to diversify. Very, very, very important. If you can hit that thumbs up. It helps me with the YouTube search, and the algorithm shows this stream to people that might not have seen it before. Mike, I can put the disclaimer on the screen. I wasn't quite ready to do that this week, but yes, I will be putting the disclaimer on the street in future to get a little more techy. And we even have sound effects. I mean, check this out. Look at that. And applause. And even a bicycle horn. So, imagine. The things that we're going to be able to do in the upcoming weeks are going to be great. The stream is going to be very interactive. And again, I'm super excited about having guests come on the stream. If you're watching this and you're a peer-to-peer lending company owner, contact me. I want to get you on the stream. And have you talk to me and have a discussion. We'll talk about your business and what's going on in peer-to-peer lending. My plan, I want to get Stuart Law in here from Assetz Capital, Loanpad, AbleRate. I do not have a noise for Lendy. It would be a poop noise or a flush down the toilet. That's actually a really good idea. I'm going to work on getting some sound effects. I'll be like a Jim Cramer. The stock guy is doing all the crazy effects. But yeah, it's good to see everybody. Okay, if you haven't joined the Lendy Action Group, I'm going to go ahead and put the link as always. I would highly recommend that you do that. Still working my way around this new software. That's the Lendy Action Group right there. And we also have the Funding Secure Action Group on Facebook. So go ahead and join both of those. If you just want to stay informed, it honestly is the best way to do it if you're an investor. And even if you're not an investor, you just want to keep abreast of what's going on in those administrations. Recommend joining those two groups there. Also, sign up for the Facebook group if you haven't already done that. This is the Financial Think Facebook group where we talk about investing, have a discussion, and all things investing discussed there. We're a very friendly group. Welcome. You can chat about whatever you want. Hi, Arthur Atchison. Nice to see you today. Okay, so let's crack right into it. Just position this on the screen. Loanpad, again, always do a Loanpad weekly update. Everything just seems to be slow and steady. They've increased their loan book about 600,000 from last week, up to £13 million now. Average loan to values crept up just a little bit to 33%, still extremely low. 31 loans, up 1 loan from last week of 30 loans. Still got 1 defaulted loan, 2 extended loans over 7 tranches. Again, those extended loans usually come because of delays. There's property development, things do get delayed, and loans do tend to get extended, sometimes not a big issue. 1 overdue loan that has 4 tranches, average loan size of £421,000, and currently £15,400 of interest being serviced from Loanpad's provision fund, which is the ICF. So everything just really tinkering along there with Loanpad, not much change, which is a good thing. I mean, we're going to see these rate reductions happen over the next month, which is just kind of part of the landscape of what's happening with the interest rates at the moment. In order to stay competitive, Loanpad's borrowers are going to have to drop their rates, which unfortunately gets passed along to you. But I think that you're just going to see this in general now. So again, Loanpad is, my opinion, very low risk, low reward when it comes to peer-to-peer lending. So I'm happy with the way things are going there. But again, diversify. You don't want to put too much money into any one of these peer-to-peer lending companies, just in case, because there always is risk. A little bit of AbleRate news. And I have invited David from AbleRate to come on the stream as a guest. So I'm hoping he will take me up on that, which I'm pretty sure he will. He's a very open person, very outspoken person. So it'll be interesting to have his comments about what's going on in the peer-to-peer lending world. They're going to be pausing their secondary market this week to launch it's called ASMX, which is going to be a place where you can come to trade your pieces of your peer-to-peer lending loans. My one thing about AbleRate is their secondary market has always been, I found it to be a little bit complicated. I got my head around it eventually, but it's not the easiest secondary market to use. And I'm hoping that the new ASMX platform that they use now for their secondary market will be relatively simple, even though I have a bit of a feeling inside that it's going to be pretty difficult to use, but I don't know that for sure. If it's simple, hopefully it'll be usable. They're also trying to get some liquidity injected from outside finances. Liquidity is everything right now in peer-to-peer lending, and we're seeing it in companies like Seedrs, where people are trading these shares on the secondary market, and how important the liquidity is. So the fact that AbleRate is introducing a new system to be able to create a more liquid platform is definitely a good thing. AbleRate is definitely on the top of my high risk range of what I'd be willing to invest in. So I have a small investment with AbleRate, but I like what they're doing. They seem progressive with the liquidity. So ASMX will be, I think, introduced next week, probably towards the end of the week next week. So if you hop on your AbleRate platform and see that the secondary market is gone, it's just that they're pausing it to test out the new ASMX integration. So that's pretty cool. Assetz Capital, I did notice this morning the discount on the QAA has gone down a little bit. It was kind of around the 8% mark last week. I noticed this morning the discounts have dropped down to about 6.4%. It's kind of what I thought would happen over the longer period of time. I think you'll see those discounts start to decrease, but they still can be very up and down if you're trying to exit. You want to get your money out of the QAA, the quick access account, you're still going to have to offer a discount. And unfortunately, there's no queue. You're not able to see what other people are offering for the discount. So there is some amount of luck involved if you're a seller and you don't want to offer your pieces at 6% or 7%. You're just going to have to keep logging on and see what the current rates are. I don't think they're going to drop much below 6% myself for a while, but we'll see what happens. I did put in a request to withdraw from the 30-day account with Assetz Capital because I was interested to see what the movement would be like. You know, it is a 30-day notice account. I'm just going to show you a quick screenshot here of what's going on. So, wow, look at this. Look at this technology. This is great. So you can see here that this is my results from withdrawing from that. And I have a relatively small amount of money in there, a few £100. And I put in the, let me see, I put it in on July 10th was the first time that I put in that request to exit. And you can see there's just been a tiny amount of releases from there. That's all I have so far. I think it is about 95 cents. Sorry, 90 cents, 95 pence total that's been withdrawn out of the Assetz Capital 30-day account since July 10th. So we're talking about almost 3 months now, and very little movement in that account, which, you know, I kind of expected that was the way it was going to be, but I was a little bit more hopeful that some more movement would occur, but that obviously isn't the case. So that's what's happening with the Assetz Capital account. Let me try to go back here to, anyway. So I'm on the screen sharing. This is me still trying to work out how this whole thing works. There we go. Okay, back to it. Yes, so Assetz Capital definitely slow with the exiting. I think it's going to be like that for a while. So I got 95 pence back so far. I think I don't expect that that's going to move much at all, but I wanted to test it anyway. Other Assetz Capital news, we saw that they've raised £1.5 million through Seedrs and the government future fund. So what they did was they need funding. So they go ahead and put their campaign on Seedrs, and whatever they raised on Seedrs, the government would match it. So they raised half of the £1.5 million on Seedrs. The government matched the 750k, so they've raised £1.5 million of capital to keep themselves going forward, which is a good thing. What else? Ratesetter. So yeah, a couple of different pieces of information this week. Ratesetter has changed the way that their provision fund is working. Obviously, with the Metro Bank takeover, Ratesetter is probably being a little bit puppet steered by Metro Bank, because we saw, you know, a couple of I think were pretty significant changes this week. So what the provision fund used to do is if a borrower is late paying after a month, I think it was the end of month 3, so on the beginning of month 4, the provision fund would then pay out the entire capital and interest owed on that late paid loan. What they're going to do now is the provision fund will pay the capital and interest monthly rather than paying the whole thing after month 3. So that will put less of a strain on the provision fund because we'll be paying out smaller amounts over the months versus one big chunk, which is, I think, you know, obviously we've seen Ratesetter have some real issues with their provision fund, and hence them diverting 50% of incoming monies into the provision fund rather than paying it out to the lenders as a return. So they're doing whatever they can to curve that provision fund, make sure that it doesn't deplete too fast. So paying out gradually over the loan term. So if a loan term is 12 months and it goes late or defaults on month 4, then they would pay the capital and interest out to the investors through the provision fund over the next 8 months versus all in one go on month number 4. Ratesetter says that investors may be matched or continue to be matched to consumer borrowers who are in default, whereas previously these loans would be charged off to the provision fund. So that's kind of an interesting thing, that if you are an investor in Ratesetter now, what's going to happen, because the loan isn't going to be charged off anymore, so it's going to continue over the loan term, that you may find that you're getting invested in loans that are defaulted. It really doesn't change too much, in my opinion, to you as an investor, since your Ratesetter covers all investors equally through using that provision fund. The only way that would affect you negatively if you were an investor is if for some reason they changed the provision fund system and then said, well, you now are not covered by that provision fund anymore, and you find that you've been invested into a bunch of defaulted loans. I don't see that happening at all. I think that would be hugely disruptive to Ratesetter. So yes, you may find now that you are getting invested into loans that are late or defaulted. Ratesetter says the new procedure will improve the management of the provision fund's cash flow by better aligning its income with the payments it makes to investors. I think I kind of like that change in a way. I like the fact that those payments will be spread over the loan term rather than it reducing the provision fund in one chunk. Because I think that's the biggest concern with Ratesetter, is if that provision fund does get depleted, then that's a big problem. So they're being proactive when it comes to that. Ratesetter this week also making a big, huge U-turn on their 5-year product. What should we play? The party noise? How's that? I don't know. I didn't hear it, but they decided to re-implement their 5-year product after informing us previously a couple of weeks ago that product would be discontinued. They've gone ahead and said that's because people have written to them, their investors, and said that we want this 5-year product to continue. I don't know if that's the truth or not. I don't know if that's because Metro Bank is again pulling those puppet strings on that market. But yeah, that's I think is a good decision for them. So what they've said is, following feedback from investors, we have decided to keep the 5-year market open. Ratesetter says this means that as an existing investor in the 5-year market, you can continue to choose to invest and reinvest in this market. Please note that all new unsecured personal loans are being funded by Metro Bank, but Ratesetter's existing unsecured personal loan portfolio continues to be managed, and it's this pool of existing loans you'd be investing in. So what that means is that new loans, unsecured loans, Metro Bank is going to be funding those. So peer-to-peer lenders will no longer fund any new unsecured loans. But the existing pool of unsecured loans, peer-to-peer lenders would still be investing inside of that existing pool. And also any new secured loans that come in, peer-to-peer lenders will be the ones funding those. Metro Bank doesn't want those loans, so they're giving it to you as a peer-to-peer lender. Yeah. Ratesetter says our focus on investment performance will remain throughout. We would like to apologize for the fact that we announced we were going to close the 5-year market, only to announce today we are keeping it open. But we are confident that this reflects the wishes of investors, and we hope it is a decision you welcome. Let me know what you think about that. If you're in a Ratesetter investor, what do you think about this turnaround? It seems they can't really make up their minds to what they're doing, but Ratesetter's rates are pretty crappy at the moment. I personally exited out most of my investment with them last month, and don't have much of an interest in going back until the rates are very much more attractive. Funding secure. So a couple of loan announcements this week of administration. We had one that a loan amount was defaulted at £1.4 million, and the guide price now on the property, which is being marketed, is $600,000. So, the borrower failed to complete the proposed refinance, and it looks like they had a non-refundable deposit of £124,675 that was kept. So hopefully that will go to the total recovery amount. But again, you're seeing another blundered valuation here of a loan, $1.4 million, and funding secure administrators now marketing this this property at $600,000. Whether they get more than that is questionable, but by the time you take out the fees of the administrator, you're looking at a significant loss on that property. And another loan, this one was a £805,000 loan with a valuation of 1.2 million. They have marketed it and received an offer and accepted an offer of 725,000. So not too bad on that one, but again, those administration fees are going to eat up some of that recovery, meaning that investors will take another loss. Certainly not as bad as the first one that I mentioned. So we are seeing some movement there. A little bit of good news. Let's talk. I always talk about some of the bad news in peer-to-peer lending. So good news, I think Kuflink is still continuing to motor forward, which I'm happy to see. They announced £90 million have been invested in their platform since 2016. 2.1 million lent in September. They've repaid 1.2 million in capital and interest in September alone. I still like what Cufflink is doing, but I do say that you should really want to pay attention to the loans that they have in there, because some of them are not as attractive as other loans. We've got a lot of second charge loans in there, which I personally don't touch because I don't think the interest rates are high enough that they pay to lenders. And then you just have to kind of read the information, get a bit of background on the experience of the developer. There is some due diligence involved in investing through Cufflink, but they're motoring forward and they're presenting new deals, which is good. If you want to score yourself some cash back if you're not an investor right now, they're offering a really good cash back deal. You can get up to £4,000 cash back, and I'll put a link in here. Just get yourself some cash back if you want to try out Cufflink. I'm still a Cufflink investor. I think they're doing a pretty good job. Obviously, there is some risk involved. It's property development financing and bridging financing, so keep that in mind. Octopus Choice sent out an update. They've returned £31 million in loan capital, which is 13% of investors' capital so far, and the loan book is providing returns to investors of 4.65%. They've removed the Octopus management fee to increase those returns to you as a lender. So really doing the right thing. Octopus is showing that they're doing the right thing by investors. They were one of my preferred peer-to-peer lending companies. I went to visit them. I was really, really impressed with Octopus Choice, and it's a shame that they're not going to be continuing it for the time being. They wrote about that regarding reopening of trading. It's clear that the demand for withdrawal still exceeds demands for investment. This means that trading would not provide the liquidity required for the platform to function. For this reason, we have currently no plans to reopen trading. That's really kind of a shame, and I hope that does change, because Octopus is one of the companies that I think was doing a really good job in the peer-to-peer lending space. Let's talk about Wellesley and Co. So we had this CVA, which is the voluntary administration proposal. I probably butchered that when I say CVA. It probably doesn't stand for that. I can't remember what it stands for. But it's a proposal that's been put forward to creditors. I think creditors voluntary something agreement. I'm sure somebody will correct me on that. Let's talk about what's going on inside of that agreement. So let me pull up, if you haven't seen the review or the updated page that I put up on Financial Thing about Wellesley and Co, go ahead and check that out. It's what Wellesley has done, and I did read the CVA. It was quite long. I didn't read the entire 200 pages, but I kind of skimmed through it. So what they've done is they've got a loan book that they've created a company within the Wellesley Group. That is, the directors are Mr. Wellesley himself and Andrew Turnbull. And Wellesley went ahead and sold the loan book to this secondary incorporated company for a pretty good discount. And the thing that pisses me off about that is that they did it without, letting people know what they were doing. They didn't consult with investors beforehand. They just went ahead and sold it to their own company. And the reason why they did that, so they'd said, and I've listened to the webinar that they did on that. They said, well, we put the loan book for sale, and this was the offers that we got were just not very good. So we went ahead and made a better offer and sold the loan book to ourselves. Yeah. I wonder, is that even question? It seems a little immoral to me at the very least, but what they're doing is they're asking investors to vote on this. And unfortunately, the people that are going to get hurt the worst are the people that invested in the unsecured mini bonds. And I said this on my review a long time ago, that made sure you understood what you're investing in. Because if you're putting money in an unsecured mini bond, you're basically lending the money to Wellesley. And this is exactly what's happened. Wellesley is now saying that unsecured bond holders are going to receive a penny on a pound, whether the CVA proposal is accepted by creditors or not. And by the way, if you're a investor in Wellesley, you get to vote on that CVA proposal, and I think it ends the voting on October 14th. So go ahead and vote on that. When I first wrote my update, I said morally I would vote against the CVA just because I didn't really appreciate what Wellesley had done with selling that loan book at a big discount. But after thinking about it, I think probably if you're a secured mini bond holder, my opinion, you probably want to vote for the CVA in favor of it. Peer-to-peer lending, the same. What Wellesley is basically offering, if the CVA proposal does go through, that you can choose to take equity and in Wellesley, which means you'll become an equity holder of, you become an equity shareholder in Wellesley, and you'll get a slightly better outcome. For instance, secured bond investors will be paid up to 84p per £1 for a cash out, or 90p per £1 as an equity stakeholder, and those payments are likely to be made over 3 years. Peer-to-peer lenders would be paid up to 48p per pound, and unsecured mini bond holders would be again paid 1p out of the pound, which is the worst result for them. And they're saying if Wellesley goes into administration, unsecured mini bond holders would receive nothing. Secured investors would get up to 78p per pound, and peer-to-peer lenders up to 44 pence per pound. I think those numbers are extremely optimistic when you're talking about an administration, because we've seen it time and time again. That never goes the way that is predicted. So that's why I'd sort of lean to voting for the CVA. There's a real downside to both. I mean, you're talking about, and certainly if the CVA were to be accepted, I would definitely cash out. I would certainly not want to be an equity shareholder in Wellesley. Obviously, they've failed pretty badly as a business, and why would I want to hold shares in a company that is not doing well or cannot seem to do well and has made some questionable business decisions without informing investors? They said that they sold the loan book so that it would be a better outcome for investors, because if they sold the loan book to a third party, the losses would be much greater. I do understand the argument for that, and obviously they want to do what's best for investors, I hope. What I don't understand is the idea of them pushing this through before they release the CVA proposal. So they basically sold the loan book and didn't give anybody a chance to vote on that. Maybe that should have been something that the investors could have voted on. Or maybe they could have taken more time. The reason why Wellesley is in trouble, incidentally, is because they've got these development projects that they've lent money on, and these projects you have to pay the contractors, and right now the work's gotten delayed. The contractors still have to be paid. Apparently Wellesley doesn't have the money to do that. And one of the interesting questions on the webinar is, well, since they've sold the loan book, how does Wellesley have the money to buy the loan book? Well, it's a deferred payment, so it's going to be over the next year in 3 stages that this new company, Cloverleaf, will pay Wellesley for the loan book in stage payments. So, does it get paid? That's another question. If you vote for the CVA proposal and you vote in favor, what's to say that those payments, don't happen at all? There's no guarantee there. It's a big mess over at Wellesley, and unfortunately, especially if you're an unsecured mini bond holder, I feel bad for you. But I also, the risks were out there. The warning signs were everywhere. If you invested in unsecured mini bonds, you're investing in the company. So, make sure that you are aware of what you're investing in. So, yeah, that's what's going on. I do feel that the CVA proposal is very optimistic, and I think the investor losses are going to be more than what is being proposed in that CVA. But again, that's just an opinion. We shall see what happens in that situation. It's not good news for the peer-to-peer lending industry. It's another contraction of the business. However, you got to get rid of the bad to see the good, and there are some good companies out there. Wellesley, personally, not one that I would invest in. So there you go with that. What else do we have this week? FCA banning crypto derivatives beginning on January the 6th, 2021. For anybody that doesn't know what a derivative is, it's an arrangement of an instrument such as a future option or warrant whose value derives from and is dependent on the value of an underlying asset. Now, the reason the FCA has banned this because they, number one, think there's a lot of scammers out there who are selling futures and options on cryptocurrency, and also because it's a very difficult product to value right now. Very volatile. So the FCA has announced a ban on the sale of derivatives and exchange-traded notes linked to cryptocurrency and crypto assets to retail customers, and they claim it will save investors millions and millions of pounds. Yeah, I don't think your average retail person is out there buying derivatives in cryptocurrency, or cryptocurrency assets. But FCA obviously has made a lot of cock-ups within the peer-to-peer lending sector, so maybe they're trying to really watch themselves when it comes to anything risky, and believe it, anything to do with options and futures on cryptocurrency assets is extremely risky. So I would say it's probably not a bad thing that they've gone ahead and banned the sale and marketing of derivatives on crypto assets. LendingClub, the huge peer-to-peer lender in the USA, is going to be stopping peer-to-peer lending. Now, it's a bit of big news this week. LendingClub was one of the big 2 peer-to-peer companies in America that first started with, there was Prosper and LendingClub. So they've had a 90% fall in loan originations this year, and they're going to become a bank holding company offering bank products like high-yield savings accounts. You won't be able to, if you live in the USA, you won't be able to open an account anymore with LendingClub. Obviously, they just didn't see they could make any money in their existing peer-to-peer lending business, so they will become a bank. Similar to what I think is going to happen with Zopa. Eventually, I think Zopa will just turn to their banking products and probably ditch retail peer-to-peer lending. LendingClub following suit. And what else do we have? I think there was one other bit of news. Nope. That's it. That's what I got for you this week. Hit the thumbs up if you are enjoying the stream so far. I'm going to go ahead and read your comments. See if you have any questions. If you do, put them in the comments and I will do my best to answer them. Let's see what's going on. No, we have a big election this coming up in the next 3 weeks in America. It's going to affect the stock market some way. Just obviously nobody knows how that is going to affect. I definitely wouldn't personally go to cash before the U.S. election. As you know, if you're somebody that invests in the UK stock market, so you're very footsie heavy, it tends to have a knock-on effect to whatever happens in the US. Really tends to mirror in the footsie. Personally, I think Mr. Trump is on his way out, but how the stock market reacts to that is anybody's guess. And we saw it when Donald Trump got elected. The stock market dropped significantly and then rebounded pretty quickly. So again, market timing in stocks is extremely difficult. Not to get political, but I will not be sad to see the back of Mr. Trump. I think he's very unstable. Okay, so Paul says, could you dwell on the relationship between stocks and bonds and how we can exploit each? Obviously, at the moment, bond funds are going to be suffering from low yields, but they do look forward. Some of the bond funds that I have invested in are forward-looking 5 to 10 years. What happens with those bond funds is obviously you're looking future yields, and they're expected not to be high. So I don't think you're going to see too much movement in the prices of those bond funds. What I do use them as a hedge for a stock market downturn. You could almost say it's a little bit of insurance if you wanted to rebalance from a bond fund into a stock fund when the stock market corrects. If you saw what happened in March, if you owned a bond fund, you might have seen your bond fund maybe drop 7 or 8% when the equity markets were dropping significantly more, 25 to 30%. So the way you could exploit it is to reallocate from a bond fund holding into an equity index tracker or something like that when the stock market corrects downwards. The problem with that is market timing becomes extremely difficult because you don't really know when the bottom of the market is. So when do you allocate or when do you rebalance? That's a tough one. People that tend to invest in bond funds are not really doing it for income anymore because the income yields on those bond funds are pretty low. So I'd say the best thing to use them for is a hedge, just to protect your investment somewhat. I did hear an interesting line that somebody told me. He said bond funds allow you to sleep, whereas equity funds allow you to eat. So bond funds do provide a little bit of sleep at night. And again, it depends how old you are, how much you need that money. If you're very close to retirement and you don't want the exposure into equities, moving to a bond fund is pretty much your only option other than cash. So you're not going to get a lot of appreciation on it. But having said that, I mean, since March, some of the bond funds have gone up about 6 or 7%. But I don't think from there you're going to see too much appreciation on the NAV prices of bond funds. But I keep about, of all my stock market investments, I've got about 20% in bond funds. And sometimes I do feel that urge to just get rid of them and move them into 100% equities. But I do remember the day that I watched the market correct in March and I looked at my index tracker funds and how much they dropped. And I remember that stomach sinking feeling of seeing those losses. And then I looked at my bond fund account, it hadn't gone down a whole lot, and I was thinking, wow, I'm glad that I had a 20% allocation of the bond funds. So yeah, that's my opinion on them. It really depends again on your risk tolerance, how old you are. If you're 20 years old, 30 years old, you just don't need bond funds. You've got plenty of time to rebound from the stock market movements. Since the bond funds are just not paying any good yields, there's not really any point in holding them when you're younger. Good question though, Paul. How did you like the little comment pop up? I think that's pretty good. Let's see what else we got here. Yes, Brian, we do have a, hopefully I'll have a high quality guest for you next week. That's what I'm hoping for. See if they come on board. It takes a lot of guts for a peer-to-peer lending company owner to come on the stream because he doesn't know what he's going to face. I'm going to try to see if I can find Mr. Liam too from Lendy. Probably not, but you never know, right? Maybe he wants to put his story out there. Maybe he's been grossly misrepresented and misunderstood. Oh yes, Mike said, what about the Wellesley? Yes, there is a Wellesley action group on Facebook. I don't have the link for it. I forgot to put it in my notes, but if anybody has the Wellesley action group link, go ahead and please put it in the comments. I'll do a quick search for it. Wellesley action group. I don't think that's the right one. There's a couple of different Wellesley companies. Yeah, if anybody has the link for that, please put it in. Tony says, when transferring an ISA from one provider, how long has the old provider before they must transfer the funds? Some are very slow. Tony, I don't know what the actual rules are. I think it depends on some. I know some providers are just really difficult when it comes to that because they don't want to release their ISAs to their competitors. But I don't know what the FCA regulation is on the amount of time that the companies have to do that. I can find out for you though. Norman says, it's getting hard to diversify in good peer-to-peer companies. They're a shrinking group. Absolutely, you're right. I know I said I would have something new for you this week. I still haven't finished my research, but I got another company that I think is going to be somewhere that I'm going to try out. Next week, I'll definitely have that information for you. It's very different. It's not based in the UK, so there is some more risk involved not being FCA regulated, even though how much good does FCA regulation do at this point, I'm not sure. But yes, it is becoming more difficult. I would certainly shrink down my portfolio of the different peer-to-peer lending companies that I've invested in versus 3 or 4 years ago when I think I was in 16. I think maybe there's about 7 or 8 decent companies around right now. But yeah, it is becoming more difficult. So there you go. Mike answered your question, Tony. There's no mandatory requirement for anything other than cash ISAs, but the guideline is 30 days. That is a guideline. Thanks for answering that, Mike. Norman says lots of votes currently with Assetz asking for extensions. I absolutely just totally expect that. I mean, Assetz is a SME lender, and look what's happening with coronavirus. You're going to have a lot of extensions. You're going to have some of these loans that are going to go into default. It's just the way of the economic environment at the moment, unfortunately. Jackie says, hi Lawrence, interested to know what your thoughts on the UK interest rates are for the next 2 to 3 years. I know you don't have a crystal ball, but do you think it will go into negative figures? I actually do have a crystal ball. Right here. It's my crystal ball. But it doesn't work very well. It's really opaque and it never tells me anything. So what my thoughts are, I think that you're going to see flat rates for the next 5 years. I don't think you're going to see too many financial institutions going negative, but I think you're going to see 0%, 0.1%. If you're very lucky, you can get 0.5%, 0.7%. I think somebody posted in the financial book group in Facebook that you could get 1% through Aldermore, 1.25% on a 1 year. So yeah, it's not looking good, Jackie, for interest rates. They're going to be low for anywhere from the next 3 to 5 years, I believe. Patty says, Ratesetter have a pretty smooth PR department. Hey, yes, I do. Nice to see you, Aki Chat. Welcome to the stream. Andreas Ware said you were impressed by the CEO. I don't know who, which CEO. Which CEO was I impressed by? Andreas, nice to see you on the screen. Welcome. Hi, Dave. Nice to see you on the street. Dave Dawson, welcome. Glad you're here. Hi, Martin from Leeds. You are in Cineworld for a final performance. I am the only person in screen 3. I can watch a movie and you. Wow. I'm sure if there's anybody else in there, they would not like to hear me nattering on through Mission Impossible 16. And as I recall, I think, Martin, you said you were a shareholder in Cineworld. So is that the reason you're going to Cineworld? Trying to increase their share profits. Hi, Chica Boy. Nice to see you here in the screen. Thank you for the comments about me looking younger. I did shave this week. Paul News says seems to be even more defaults with Assetz Capital. Yeah, again, you are going to see some defaults, just the nature of SME lending. The good thing about Assetz Capital is a lot of their loans get paid down. They are amortizing. So some of them are paid at the end, but most of them are amortizing loans. So a lot of the loan balances have drastically been reduced. So I know Assetz is being proactive when it comes to late payments and things like that, but we'll see what happens. Again, it's SME lending, so there is some risk involved in the nature of what's going on in the COVID economic environment. Martin says, do you think Cineworld will survive? I don't see, unless Cineworld figures out a way to get themselves online somehow and broadcast films that way. I just don't see that people are going to be flocking to go to the cinema. I mean, especially with what's going on with the increase in the COVID rates, I don't know anybody that wants to go to a cinema. And do you? Would you go to a cinema right now? I mean, I guess if they space people out 6 seats apart or something, but you can pretty much watch films at home now. And I know Amazon is doing Prime where you can watch released movies through there. So I don't know necessarily why people would want to go to a movie theater. But you do own Cineworld shares, Martin. I know that you might want to have shorted those instead, but we'll see what happens. Paul says, anything new from Funding Circle? Paul, I've absolutely heard nothing from Funding Circle this week. Chicka Boy says, thumbs up for everybody. For the wonderful Lawrence. Yes, thank you, Chicka Boy. If you can, hit the thumbs up. Otherwise, Chicka Boy will come and get you. Thank you for the... yeah, thank you. So, Paul News says, so Sleepy Joe is better. We're going to have a little political discussion. Well, do I think Joe Biden is better? I don't necessarily think he's better. I just don't like Mr. T. And I think he's said some really stupid things, you know, when he got out of hospital and with his coronavirus, saying, oh, coronavirus isn't a big deal. I think it was very irresponsible. And I would just think that America needs a change with its president right now. I don't think Joe Biden is a necessarily much better choice, but he's definitely somebody I prefer over Trump. I just can't deal with the drama anymore of what Trump is just so unstable and doing crazy things. But I asked a friend of mine, why are the presidential candidates so crap? And he said, because nobody wants to do that job. It's paid $400,000 a year. You don't get any freedom. And it's just a crappy job to be the president of the USA, so the candidates tend to be pretty crap. Dave Dawson says, how do we rate property land against crowd property? I'm looking at my next peer-to-peer lending. So when you say property land, I presume you're talking about prop land. I've been to visit prop land, and I like their operation. I've never invested through them. I've got an interview with Mike from Crowd Property up on my YouTube channel if you want to watch it. I wouldn't think that either one of them is a bad choice. If you can do both, I would say sure, go for it. I've been impressed with Crowd Property so far, but I've only been investing with them since June. And I was pretty impressed with the PropLend guys. I just haven't invested anything through them. Paul says, I assume bonds are low yields because of interest rates. Yes, absolutely. Bond yields are low exactly because of that. Mark Mason says, comment pop-up is a good idea. Yes, nice to see you, Mark. Welcome to the stream. Mark from the Funding Secure Action Group. Yes, I do like the comment pop-ups. It's definitely good. John says, regarding unbolted, how do you define the difference between standard L loans and, how do you define the difference between standard loans and business loans? They look very similar to me. I think that probably the securities that are held for them. I don't invest in the business loans, so I'm only investing in the loans that have securities behind them, but I imagine the business loans aren't secured in the same way that the standard loans are. I can take a look and let you know next week. Or I'm sure somebody else can answer that question. Alan says, Assetz blend, crowd property, Cufflink, LendInvest, Loanpad, and unbolted. It's 7 for me. Yeah, I think that's a pretty good range of diversification in what peer-to-peer lending offers right now. It's almost identical to what, if I was starting my peer-to-peer lending portfolio today, I might throw in PropLend too. But yeah, I like Blend. I like what they're doing. Assetz seems to be okay at the moment. Crowd property, Cufflink, good. LendInvest, yep. Good operation. Loanpad, yep. And unbolted. Unbolted is my sort of like dark horse, higher interest rate lending. And there are a couple of other good companies out there, but I've learned the hard way about diversification, making sure not to put too much money into any single company. So AbleRate seems pretty good too. But again, that's not advice, that's just my opinion. Also, Just Does. I think it's Just Does. Just Does. I've heard good things about an invest and fund. But again, I don't invest in either one of those. Glad you like the crystal ball, Jackie. It's this crystal ball has some history behind it. It came from Aruba, the island of Aruba in 2000 and I want to get this right. 2003. So I actually went to Aruba in 2003 and played poker there, and I won this crystal ball in this little stand. So now it's my predictor of everything in life. Mike says, have you seen the Cineworld share price? You know, I have not. How much are they? 39p. Is that right? And the US are 39p. 39p, 30, are they 39p? I agree. 29.52p. Hey, they're up 9.3% today. So if you bought today, you're doing okay. Do they pay a dividend? What's their dividend? Probably not. Yeah. They've dropped a lot. The price. I guess Martin must know something that we don't about Cineworld. Maybe he bought them when they were in the doldrums. Jickaboy says, I would not go to the cinema. Nah, I don't blame you. Let's see. Have Blend had any defaults? I don't know about that. Let's have a look at the statistics. So this is Blend's. Let's have a look and see what Blend networks. I don't think they've had any defaults. Steven said, still looking at Blend. Have they had any defaults and how have they worked out? Let me have a check. On the website it says, so 2018, 4.5%, which is one project that was in arrears, and since 2017, let me show you this. You can see it right here. This is Blend Network's actual default. Looks like 2018 they had one default and none else, and I don't know what the outcome of that has been, so it's pretty good. No default, well, one default. So I can ask Yan, see what's going on with that. I don't know today. The disadvantage to Blend, and the reason why I haven't invested yet, is because you have to put in £1,000 per deal. I just haven't had any capital that I wanted to put into that company yet. Because I mean, really, if you want to diversify, you got to put really 10 grand in there. You want to have about 10 projects. Dave says, I think with all politicians, it is the least worst. Absolutely. Yeah, that's what happened with Trump and Clinton, right? Everybody was thinking, oh, Hillary Clinton was the worst, but Trump they thought was a little bit better than the worst, and went ahead and voted for Trump. Cineworld owes $7.2 billion, closing tonight until April 22nd. I suspect it will fold. I sold my shares before lockdown. Oh, okay. Yeah, that's not good. They're probably going to close. $7.2 billion? They're closing until April 22nd, April 2022. Yeah. Andreas says, I went to the cinema this week. All good. This is a flu. Plus, completely overstated. Okay. So, I have a friend that got coronavirus and has been sick for almost 30 days from it. So, I think it just affects people in different ways. I think I might have had it, and I didn't know that I had it because I was around somebody that had it. And he got sick for a couple of days, and then he was fine. But I didn't have any symptoms. I never went to get tested because it was very early on, and there was no testing available. Sorry about the light. The light went out because I forgot to charge it because I'm lazy. But yeah, I don't know. I don't think the people that have said, have lost relatives to coronavirus would say it was overstated. But I've seen some reports that it is much lower death rate than the flu. It's really hard to know what to believe. I don't know. I think the CDC released, let me see if I got it. CDC released the numbers on, I don't know if you could see this, but probably can't. It says that 50 to 69-year-old, 0.005% death rate, 70-year-old, 0.05% death rate. So even if you're 70 plus, according to the CDC, you'd be okay, but you just never know. I think it has been very overstated, though, in some ways. If the death rates are higher from the flu, and they've never shut the entire countries down over the flu, so quite a few defaulted loan on Funding Circle, Peter Vince says. They've started repaying in the last few months or so. That's really good news. Martin says, I hope President Trump recovers, and then I really hope he gets better. He's been very defiant about, they were trying to have Trump do a virtual debate with Biden. Biden accepted. Trump said no. He's just going to do a rally instead. He's just a very defiant guy. Chica hasn't heard my new sound effects yet. Oh, okay, hold on. Here we go. This is my favorite one. Paul News says CDC 0.13% mortality rate, overwhelming over 80 with health problems. Yeah, I think anybody, even if you get the flu when you're 80, you're susceptible to having major health issues. Dave says, I would not invest in Cineworld. It's just speculation if it will survive or not. Absolutely agree. Does this new technology rig the clock? Apparently started 22 minutes ago. I don't know. That might be a bug. I don't see what's happening on YouTube at the moment, so maybe I got to adjust it. Ian says, welcome to the stream, Ian Fotheringham. Nice to see you. Welcome, welcome. BBC says 3 times as many people have died from COVID than the flu and pneumonia in England and Wales this year, according to official figures. I think you got to be careful too. I don't know. Some of the media information on COVID is weird, but the CDC seems to change its mind about the numbers. One other thing too, I've finished the video for the stock portfolio that I put together. I did a little test and invested about $5,500 of my own cash into single shares. It was an experimentation. I wanted to track it over a year and see how my portfolio did against my trusty index trackers. I'm going to be releasing that video in the next couple of days. And the portfolio is actually is doing really well. I think I got very lucky in the market time. I just happened to buy on a drop day when the stock market had gone down. I don't expect that the my stock fund over the period of 5 to 10 years is going to beat the indexes by any means, but it's going to be interesting. And I'm going to put up a video every week to track what's going on with that. I did it through Trading 212, so I'm going to put a tutorial video up on there too, how to use it and how to use their investment pies. So pretty happy so far. Anyway, we're going to wrap things up this week. Glad the new technology worked again. Hopefully next week I'll have a guest for you. Just remember, on the 29th there will be no live stream. Put that in your calendars. We'll be back on November the 3rd. I think is the next date. I'm going to be taking a bit of a holiday, having a break. So again, thank you to everybody who joined the stream. Please subscribe to the channel if you can. That helps me out a ton. And have a great weekend and a great rest of your week. Be healthy, be safe. Remember, there's more to life than money. And be safe, everybody. Take care.